There's always this question around US performance, right? People say, I should invest more in the US or solely in the US because it performs better. But I don't like the phrase, it performs better, because that's implying a state of permanence. Like it's just an undeniable fact that will continue indefinitely, which I happen to disagree with. I don't think that's very intelligent despite, the recent performance in the last decade and a half. And you could say that the performance has gone on a lot longer than that. But then if you look at figures of like since 1900, which is pretty damn long term, Australia and the US have performed basically the same.
The Aussie Fire podcast is a collaboration between Strong Money Australia and Pearler, Australia's favourite boring long-term investing platform. Join our hosts, Dave from Strong Money Australia and Hayden from Pearler, as they discuss all things financial independence. At Aussie Fire, we're big fans of sharing experiences and talking about money. However, please note that any advice is general and does not consider your financial situation, needs, or objectives. Consider whether it's appropriate for you and, if in doubt, speak to a licensed financial advisor.
Hello everyone, welcome back to the podcast. In this episode, we're going to unpack a listener's question about ethical ETFs, and we're also going to talk about, related to that, the US market specifically having more ethical companies, so we can talk about that in more detail. And we'll speak more broadly as well about ESG investing and ethical ETFs that are available and things like that. So this should be interesting because it's not actually a topic that we've covered before on the podcast from memory, so it'll be good to dive into it. Hayden, I have absolutely no idea of your thoughts on ethical ETFs and all the rest of it, so it'll be good to unpack it.
Yeah, let's go discover that.
All right, I'll read out the listener question. So essentially it's around the topic of should I invest in the US because it's more ESG heavy, and our thoughts in general on ETFs like DZZF. Or DZZF, however you'd like to say it. So here's the listener's question. If someone wants to align their portfolio with ESG principles, would it be wiser to hold less Australian equities due to the large number of mining companies and fossil fuel contributors in the Aussie market? I hold DZZF and ETHI, or ETHI as some people usually call it. I'm worried about the Australian portion of DZZF not performing as well over time, so I'm still investing a significant portion into ETHI to decrease my exposure to the Australian market. Do you think this is wise, or am I overthinking it? In contrast, is it worth having a decent proportion invested in Australia due to the franking credits and potential higher dividends? Or should I not worry about this until I'm much closer to retirement? I'm 29 right now. On another note, it seems like DZZF is a pretty solid all-in-one diversified ETF for ESG-focused investors, but it doesn't seem to be very popular. Why do you think that is? And can you see any risks investing in this specific ETF? I'd love to hear your thoughts and opinions on DZZF.
I think there's a bunch of things to unpack there, Dave. I mean, firstly, I was really drawn to the part of the question that was kind of like, why do more people not invest ethically? I think the reality with I think there's two big things. I think number one, there's been a bunch of ethical type ETFs over the last 10 years that have, you think about it, if you've got an ethical ETF, it's either going to perform better or worse than its, non-ethical equivalent. And, there's been a handful that I've seen that have performed less good over some time period. I haven't looked in a year or so. So, these things could kind of change. But most people are always going to get drawn to what makes them more money fundamentally. And that means if suddenly a bunch of ethical things do start outperforming, or there becomes like a culture understanding online, in person, just generally that ethical stuff will actually yield you better things, then people will be drawn to it. I feel like just talking to people anecdotally, there's sometimes been an attitude, rightly or wrongly, that, to invest ethically is to take a hit on performance in exchange for peace of mind, or satisfying your conscience, which isn't necessarily a true thing, but I feel like it can have that kind of vibe sometimes. But also there is an element with this stuff where just like a lot of people, particularly in the middle class or middle lower class, or people who are early on in investing and don't have a lot of capital, they just don't care. They have one simple question, which is like, what's going to make me a lot of money? And if someone could, give them an understanding that was crypto, they'd probably go and do that. Or if it was, something else, they go and do that. So at least just before we get into it, there is this interesting question of like, why would not everyone invest ethically? That seems smart. Who's like, I'm unethical? And I think there's some interesting things to unpack there, but that was just my quick side note on that.
Yeah, no, there's some extremely interesting lines of conversation that we could open up from that broader topic to get, I suppose, more concentrated on the listener's specific question before we broaden out to ethical investing in general. I would say there's a whole bunch of questions all in one, so they seem to be overthinking like 3 or 4 different angles of it.
Yeah, there's a lot on their mind.
Yeah, they're like, I'm thinking this, but also this, and then how about this, and what about that? So it seems like that, yeah, they're questioning the Australian-US portion, which is essentially going to be a personal preference over time. The ethical investing side of things is going to be a personal preference as well. And also the desire for income or otherwise is going to be a personal preference as well. Like there's always this question around US performance, right? People say, I should invest more in the US or solely in the US because it performs better. But I don't like the phrase it performs better because that's implying a state of permanence. Like it's just an undeniable fact that will continue indefinitely, which I happen to disagree with. A lot of people can argue that, yes, it is a permanent fact, but I don't like that kind of thinking. I don't think that's very intelligent despite, the recent performance in the last decade and a half. And you could say that the performance has gone on a lot longer than that. But then if you look at figures of like since 1900, which is pretty damn long term, Australia and the US have performed basically the same. So I don't think it's fair. You could say that there's a quality factor involved in US companies and them being superior and more dominant and all the rest of it. But if you're an index fund investor, you would expect that those things are incorporated into prices somewhat, right? So it's hard to then say, well, they're the best companies, they'll perform better. But if everybody already thinks they're the best companies, so they'll perform better, then people will bid up the prices to unsustainable levels, therefore making them underperform over the next 10 or 15 years, potentially. That's not a guarantee either, but it's just to point out that there is a state of uncertainty in all this. So I don't like the assumption that one asset class and one market is going to outperform forever. As I've talked about before, I don't think that's really a reasonable position to take, or it's at least a little bit too optimistic and maybe a little bit downplaying other outcomes that could come to pass. Do you have any thoughts on that? Do you disagree with that, or do you agree, or somewhere in the middle?
No, I think I generally agree. I agree in the sense that, like I have a lot of faith in America culturally from their capacity to create and support and catalyze businesses. And if you haven't, for anyone listening who's never been to the US or spent time around a lot of Americans, particularly educated, when you spend time with like a lot of educated Americans, you can get really overwhelmed by just how intense they are. Like the like competitiveness, the drive to be better, the drive to be the best. So I generally have this like faith in US businesses at the top end, probably marginally more than Australia in the next 20 years. But I think it's very academic in the sense that like, if I was talking to my father and he was like, I have all my money in Australian index shares, I'd be like, sounds great. Like it's in a broad-based index.
As in you're probably going to be okay.
Exactly. So like I could talk about it, but I don't want it to be misconstrued with actionable thoughts. It's more just kind of like academic musing is how I think about it. So yeah, I do agree in that sense. But if I had 10 spare dollars lying around, I might bet it more in the US than Australia, slightly. But nearly 30% of my portfolio is in Australia, which is quite a lot when you think about the fact that it's a country a tenth of the size. So yeah, I agree with you is the short answer there, Dave.
Okay, and as for the specific ETF DZZF, for anyone watching or anyone listening, it's basically the same as DHHF, an all-in-one globally diversified index fund, except it's the ethical version that BetaShares has released. And so the questioner is wondering why it's not more popular. I mean, it is a $100 million fund, so it's not tiny. Like I don't think it's going to close down anytime soon. So I don't think that that's a particular risk that they need to worry about. I would say because of the increasing amount of availability of ESG and ethical type funds over the last 5, 10, 15 years, especially 5 to 7 years, I would say, there's just a lot more choice of which funds to invest in. So that's partly why it's probably not a massive fund, because there's just a lot more to choose from these days, as there are with other ETFs as well. So I think that's part of it. I think the most likely risk that you would face, which is not really a big risk per se, but something Hayden pointed to before, which is just the risk of underperformance. And we can probably unpack why that could be.
I think there's also an element of they're just unknown entities, you know? Like anyone who goes grocery shopping knows this. If someone puts a new thing on the shelf and, whether it's 20% less sugar, whether it's half price, whether it's dairy free, I like the dairy free one. And I don't know if anyone else has had this experience where they saw like the coconut yogurts or whatever for the first time. You know the ones I'm talking about, Dave?
Eat
yogurt?
Yeah, okay. A little bit.
And like you look at it and you're like, it seems like they're trying to do something new and better. And then just depending on who you are, the time of day, the mood of the week, you might go, oh, let's dive into that. Or other times you might be like, I'll see what I know. I do think there's a lot of that with this ethical stuff because, you go online and you talk about, what do I invest in ETFs? You're not going to see DZZF appear anywhere near as much as DHHF in forums, in Google AI summaries, in all these kinds of different things. So I do think that there is that element too, where it's just like the known entity element of something risky is very comforting.
Okay. Yeah, I can see that. That makes sense. So just by the sheer nature of less people investing in it causes less people to invest in it.
Oh, it's written about less. It's blogged about less. It's talked about less. It's coconut yogurt.
It's the coconut yogurt of ETFs.
Yeah. I mean, there's many ETFs like that too, right? A lot of the big common ETFs get a lot of attention. I think these smaller ones, most people wouldn't even know about it. And if they did, they wouldn't know. They might know it exists, but don't know enough about it. And then if you ask them, how does it perform? They'd be like, I don't know. So I don't think you need to see a lack of engagement with people as like a sign that it is, maybe bad or something to avoid necessarily.
Yeah, I think that makes sense. So if we pivot to the topic of broader ESG investing and ethical funds, have you looked at many of these funds, mate? And if so, what are your thoughts on them? And if not, what do you think about the idea of ethical investing in general in regards to because obviously if everyone could just decide, well, why wouldn't we invest ethically? Then let's just do that. So obviously there are potential downsides in regards to that. So have you done much reading or anything about this sort of topic to think about it? Yeah,
I used to invest in Ethy for a while before I cleaned up my portfolio. I had a bunch of other ETFs like ACDC and all kinds of random things, SYI and stuff I just kind of cleaned up because I had 10 ETFs when I did some selling and had to buy some stuff later. Maybe a less popular opinion, but I try not to overthink stuff I'm not that knowledgeable about. I obviously don't like the idea of contributing to something that I think is bad, like I don't drink alcohol. And a part of why I don't drink alcohol is I don't like seeing what alcohol does to the world on balance. So I choose to not participate, right? And I think many people do that in some way, shape or form. So it makes sense to do that with ethical ETFs and stuff. But just frankly, I haven't made the time, and that's on me, to sit down and look at it because all this stuff gets really tricky. Yeah, so like one example is if I look up some of the ETFs that DZZF holds, it seems to include companies like Apple and Nvidia and stuff like this. And it's like, yeah, they're not mining companies, but what do we do about the fact that these companies are building or supplying products to companies that are mining companies? I haven't figured out how to make sense of this in my head. And I'm not the kind of person that's generally like, if you can't know the answer to something in finality, that you should just choose not to try. I think that's like a slippery slope mentality, of course. Like to say that, how do you rationalize that Nvidia is not as bad as mining companies, therefore I'll do nothing. A regular person would be like, maybe I should just not put money into mining as the starting point. But, I just haven't spent the time with it to have a view. And I try not to do things just based on like loose early vibe. So I know at some point I'll have some spare time and I'll sit down one day for 8 hours and look through all this stuff in great detail and probably look at it for more days and spend months thinking about it and then kind of wake up one day and be like, I don't really want to do that. That happened with crypto, Dave. Like I put money into crypto back in 2017 for 8 months. And about 4 months in, I was like, I don't think I like this. I don't think this is ethical. And then after many more months of it, I pulled the money out and I've never bought Bitcoin since 2017. And I don't want to ever again because of just after a lot of time and thinking. But sometimes I just need that time and thought before I can kind of really kind of lock in a view on it. So I guess semi-undetermined to be determined is how I would summarize it. How about you?
Yeah, I think about it a little bit similarly where it's just very difficult to separate what constitutes an ethical company and a non-ethical company to the point where you can exclude them in a way that's going to be materially impactful. Because you could say, well, because there's lots of different ways you could do it, right? You can say, well, I'm going to avoid these companies because I just personally don't want to own them. I don't want to be associated with them whatsoever. And I think that makes perfect sense. I know people who've done that before. So that kind of makes sense to me. The other part is you're not really impacting them. Like the idea is, okay, we're going to not buy these companies' shares and it's going to detrimentally impact them to the point that they'll be forced to change their operations and change what they're doing, or maybe shut down if they're a bad company. But I don't really see that playing out much in the real world because the companies are not thriving for the purpose that people are buying their shares. They're thriving because people are buying their products. So just by lowering demand for their shares, you aren't lowering their profits in any way. And then people could say, well, you make it harder for them to raise capital. But almost in every case, these are well-established companies that have been running for a long time. They don't need to raise new capital, so that doesn't really affect them either. So it starts to get very difficult. And like you said, Hayden, something like a tech company, you could question whether a lot of tech companies are even ethical in the first place because of data harvesting.
Is Instagram ethical?
Yeah, data harvesting and designing things for addiction and stuff like that on purpose. So you could question almost every industry, I would say. And it's very difficult because one company relies on the other company. So if you're trying to help the good companies, which might be tech or it might be solar energy or something like that, you can't hope for them to, well, you can hope for them to succeed, but they can only succeed if mining still exists. So then there's a conundrum there, you know? It's very, very difficult.
It's so hard. And I don't want this to come across as defensive of it. I remember when I was at university, I used to do a lot of marketing for the university engineering department. And we used to have to do a lot of training to learn about all the different types of engineering, you know, it's computer engineering and electrical engineering and mechanical engineering. And I remember one of the 11 schools of engineering they had was mining engineering. I remember that coming up in the booklet, in the training booklet. And I was like, oh God, how the hell, this is going to be a weird thing to talk about. Mining engineering, you know, it just sounds dirty. And the way they used to train us was they used to have someone come up and basically give a 3-minute pitch, you know, to sell you so you can sell someone else. Well, how would you inspire a 16-year-old to be interested in this field? And I remember they got up and they pretty much only had one slide on the screen for mining, which was, if it's not grown, it's mined. That's what they said. And they were like, that's the message you're trying to deliver. It's the fact that if you're interacting with anything in the world that wasn't grown, you know, out of the ground, it's had to have been mined at some point for nearly everything. You know, and it's not about that. It's about, think about every single thing you enjoy. Obviously, cotton and food are grown, but you know, whether it's your phone or all these things require this, and we're just empowering the world. And that's not to say, that's not me being oh, so everything's okay and there's nothing wrong with it. It's just, you know, I get lost in these loops of oh my God, there's more to it. Oh my God, there's more to it. And then I'm like, I have shit to do. And then I kind of get back to my day.
No, it's a real thing because then people will be like, well, it's not perfect, but surely these companies can be improved. And I'm sure these companies can be improved, which is why they have, regardless of whether a company is fitting into an ESG fund or not, they all have ESG policies because they've been essentially pressured by the public and by shareholders, irregardless of whether ESG ETFs exist, because a mining company knows they're not going to make it into the fund, but they still have ESG policies. So it's not like a quest for popularity in the sense of wanting to get the tick of approval from a fund manager to make it into their basket that goes, you know, to replicate in the ETF. But it's generally been pushed on them, this social responsibility and thinking about the world at a broader scale and the communities that they work in and all the rest of it. So you'll see that every public company is essentially working towards improving different things. Not going to be perfect, going to take a long time to, you know, move the needle on certain things, but it is happening regardless of this style of investing or not. And the other thing that comes to mind here is it's not necessarily, because you could say, we'll just do it anyway and surely it's going to help in some way, but there is a cost to doing so. And there is not just one cost, but multiple costs. So the first one is obviously the higher fees that are associated with ethical investing. And you might be okay with that, which is perfectly fine. But the tricky part is you then have to try and find a fund manager or an ETF that has a basket of stocks that meet your personal values, because it is such a personal thing on what you regard as ethical or not, or what you're willing to tolerate putting your money into or not, just for the sake of comfort, because we can argue whether it's going to actually, hurt that company or stop what they're doing in any material way at all. So there's that part to consider. And then by nature of being like, the fussier you want to be around what kind of standards you want for the companies in your portfolio, the more the fund manager has to work harder and harder to research and whittle down these companies to make sure that they fit all of this specific criteria, which takes a lot more time and a lot more resources and man hours. And so that means higher fees again. So you'll find that the more effort that the fund manager has to put in to make the perfectly ethical basket of stocks, the higher those fees are going to be. You can exclude some simple things like weapons and whatever, and it won't really cost you much in the way of extra fees. Like Vanguard does things like that, and they have a fairly sizable ethical fund, I believe. But yeah, as you kind of scale up your efforts in ESG focus, the fees are going to scale up as well. And what that also does is excludes a whole bunch more companies, which, as we know from index investing, the more companies you exclude and the smaller you make your basket of stocks, the more likely you are to underperform. That's just kind of how the market works. And not only that, but having an ESG screen effectively makes the ESG companies more popular than the other companies, which pushes those prices up relative to other companies, because they're preferred for their ESG flavor, let's say, which then causes prices to go up in the short term, which is fine, which actually boosts short-term performance by a little price spike higher than they would be. But because their earnings haven't grown anymore, they just become more popular as stocks. That can lead to long-term underperformance because you're paying a higher price for the same company and the same earnings that they're going to generate. And on the flip side, the so-called unethical companies will start to trade at cheaper valuations if they are less in demand in their shares. And so you're attempting to hurt them by boycotting them essentially, but then value investors can come in and just scoop up shares cheaper. So then they can make higher returns, or companies can even be taken private if they're deemed this is it's trading at a low valuation now. So a private equity firm comes in and buys it up, and then they trade off the market, and then they don't have to have ESG policies to show shareholders because they're a privately owned company. So you could argue that on the market is the best place to kind of police these companies and push them about what they're doing on these ESG metrics to try and improve them in some ways. And otherwise they could end up in the private space where they're less under scrutiny from shareholders and from the public, because there's less well-known and less publicly displayed information about all of their operations and things like that. So there's a few factors at play there that are going to potentially reduce returns by anywhere from 0.5% to maybe 1% per annum.
That was a crazy amount of depth and insight, Dave. Thank you.
Well, I've thought about it quite a bit because I researched it a little bit for myself, and then I've spoken about it a few years ago. And then from the pushback that I had on that, because some people are quite passionate about it, I had to think about it more and I had to research it more. And then I've just come away with sort of more realizations and lots of different ways to look at it, where I haven't really been convinced that it's needle moving in terms of changing the world, but it does come with the downsides that people don't really focus on too much, because some of the things that you'll see is kind of slippery marketing. You'll be somehow convinced by certain materials that you're going to improve the world and get better returns at the same time, but it's just unlikely due to the things that I mentioned before.
Yeah, 100%. I don't think I have much more to add. I'd probably just say, the way I think about it is, if I'm as a consumer purchasing something from what I consider an unethical company, I'm going to be encouraging it to do more of the unethical stuff. And if I purchase a stock in an unethical company, I'm going to simply be profiteering off of things that I think are bad. And those are two kind of different things. One of them is about you yielding the benefits of something you don't think should exist. The other one is about you causing the thing that you don't want to exist more. That'd be my two broad-based things to consider. So if you're considering about ethical investing, then obviously you're hopefully someone also considering about ethical consumption, and those two things are different but hand in hand.
Yeah, I think when I have pushbacks to some of the arguments, people think, well, you don't care about ethical investing, so you don't really think that anything should be done about what's happening. I'm like, no, it's not like that at all. It's like, you can do it, but just be aware that there are some downsides to consider. And if you're happy with the trade-offs there that seem the most likely thing to be true, then I think that's perfectly fine, because you can exclude those companies like from your portfolio. And so then you're not profiting from them and you feel better about that, which is good. But then you have to remember that you're paying a price for that, not just in terms of like the returns from likely excluding more and more companies, but also the fees that are being lost to the fund manager. So you could take, like if you take a broad, large example of like $1 million portfolio, and let's say just through the fees alone and maybe some drag in returns, it's going to cost you somewhere in the realm of 0.5% per annum to have your, fairly ethical funds that have been whittled down through the different criteria versus just a standard index fund. If you have $1 million portfolio, that's going to cost you like $5,000 a year. You could do a lot of good stuff with $5,000 a year, not for yourself, but to improve causes and things that you care about. So on one hand, you're trying to exclude companies and hope that it has a material impact on the negative things they are doing, or you can save that money on fees and return drag and potentially do a lot of direct good with real cash that you have saved or benefited from and have more of a positive aspect. So it depends which angle you want to take to do it. So there's more than one way to like try and move the world in the way you want it to go, if that makes sense.
Yeah, I love that. If you want to invest ethically, but you're not going to invest ethically, you could take the 10-year return difference and donate it.
I had this silly example basically where you take $5,000 a year from your $1 million portfolio, which is the difference that I just made up. And you're like, you could buy solar panels for a neighbor every year for the next like 10 years or forever. So that would have you're literally might be changing the world in the way that you want it to go, as just one silly example. But like you can do it to like conservation charities and like all the rest of it. Like they're things that you want to see improve. So I think that part's maybe underappreciated. I suppose it's more difficult. It's just less convenient compared to choosing a different fund, right? And then hoping that makes a difference. But it's definitely worth considering or remembering anyway. But if you want to look into this in more detail, I would encourage you to go on YouTube and search Ben Felix Sustainable Investing. It's a little bit of a nerdy video, especially the first half, but there's an excellent breakdown of the kind of the research that has been done and some of the things that I pointed out today, but just like in more detail and with, backed by studies and things like that. So that's very interesting if you wanted to go into more of the research and background behind why I've come to the conclusions that I have. But I don't have any problem at all if someone wants to invest in their personal preference of ethical ETFs and funds. I have absolutely no issue with that. So if you want to do that and that's what you feel best about for your portfolio and your situation, then by all means, definitely do that. But just make sure that you find a fund manager who is aligning and is using criteria that you want, because all of the ESG funds are different. So you're going to have to spend some time unpacking what they do and what they include and what they exclude so that you can line it up with how you want to invest for your personal situation.
All right, Dave, let's get to question 2 of 2. This one is basically about how do we diversify away from big tech? It's a really interesting question. So the question from the listener is, given that the market is very hot, mainly driven by AI stuff, etc., what is the best way to diversify so that we stay afloat if the market crashes tomorrow by 20% or even 40%? I have DHHF and VDHG and a bit of hack in FANG. Do you suggest any other ETFs to mix it up a little bit as my portfolio is a bit tech heavy? So we've had this kind of question come in a couple of times over the last few months. Now, just for reference for everyone listening, we are recording this episode on the eve of December, the eve of 2026, I guess I should say. So, markets can move quickly, particularly with AI and tech. So let this episode be a time capsule just in case anything crazy happened in the world. But yeah, what's your kind of thoughts, Dave, around this feeling tech heavy?
Well, it's an interesting concern to have because judging by their holdings, they've deliberately made their portfolio tech heavy. So it's kind of odd to then worry about the portfolio being tech heavy, right? And then if you dilute it, did you then not want the portfolio tech heavy? by adding other ETFs, or if you just change your mind on it, which is fine too. But it's just interesting kind of conundrum, I suppose, that's been created here with the portfolio. And the wording is also interesting too. Like, what's the best way to diversify so we stay afloat if the market crashes tomorrow by 20 or 40%? Does that imply, like, what do you mean by stay afloat? Like, are you trying to, there's two risks that you could potentially be concerned about. One, I would classify as short-term risk, which is just basically the market dropping quickly at any given point in time, which you can only really solve for that risk by investing less, because almost everything goes down together in a crash. Like, even if you're invested not in the US, if you're invested in Europe or Japan or Australia and the US goes down by 40%, you can basically guarantee that all the other markets are going to go down by a fairly decent amount as well. Probably won't be exactly the same, but they're definitely not going to be stable while the US goes down 40%, because it's going to be some type of a expected calamity that is going to affect everywhere, most likely. So the only way to really fix that is by having more cash or more bonds or more things that are not really correlated with the stock market. Maybe it's property, or maybe it's gold, or anything like that, right? So if that's the risk that you're worried about, then those are the things to consider. But if it's more of a long-term risk, like you're more worried about tech itself, or you're more worried about the US specifically, then you would solve for that issue by diversifying more into other markets, whether it's more Australian shares or emerging markets, or again, like other asset classes you can add. And that would solve for the long-term concentration risk that you might be worried about with a specific sector or a specific market. I probably wouldn't go and add like other sector ETFs here, because you've already added essentially 2 tech ETFs in addition to the diversified funds. I probably wouldn't add more smaller sort of niche themed ETFs. Not really the biggest fan of those. So I'd probably, to reduce the tech exposure, you could just sell the tech ETFs, right? That's immediately going to just bring you back to those 2 other all-in-one holdings, which are going to be, you're not really going to have to worry too much about being over-concentrated in tech. So you could do that, capital gains permitting, I guess, depending on what the story is there. But yeah, that's how I would, I suppose, solve for this concern. What would you say, Hayden?
I think that you should just focus on what you think matters over a 10-year period and invest in that. And if you feel like you're too tech heavy over a 10-year period, then invest less in the tech stuff. I don't think, sometimes with these kinds of questions, if you read between the lines, it's kind of like, oh, I want to invest in tech over the long term, but I'm worried I'm tech heavy right now, so I should try and protect against that. And it's like, that's a really hard game to play. One of my favorite things my co-founder Nick says to me sometimes is, I'll say to him things like, oh, I don't know about investing in the US market. It seems really hot and overhyped at the moment. And he always just says to me, he's like, what else are you going to do? Yeah. He's like, what are you going to do? Sit around worried, playing with the portfolio, trying to he's just like, what are you going to do? It's like, take a bet on the things.
Property, Hayden.
Yeah.
Yeah.
It's just like, take your long-term bet. I'm much more bullish on the US than I am on tech companies proportionally. So I invest much more heavily in IVV than I do in NDQ. I don't invest much in NDQ because it feels very concentrated to me. That's not to say I don't think they'll maybe do as well, but it feels very concentrated. To invest in NDQ is to basically be investing in AI data centers and AI hype right now. Now, not to say that's bad, but that's a very specific thing. Yeah. I know IVV is still a lot of NDQ in it, but just take your bet on the long term.
Yeah, that's what I was going to say, because there is so much overlap there between the broad US market and NDQ, to the point where the S&P is you could already argue it's a tech heavy market.
Yeah, the S&P is very tech heavy for sure.
Yeah. So then do you really want to kind of double, triple that up with NDQ? Because you're already, by nature, if those companies do well, then they'll be even bigger as a proportion of the S&P in 10 years time. Let's say those, the Mag 7 or whatever right now are 25% of the US market, or might even be a little bit more. if they do really well and they keep performing quite well, better than the other companies in the S&P, then they're probably going to end up like 35, 40% in 10 years time. So then how will you feel? You might feel still good about it if they're still doing well, but what about then the NASDAQ? Then your exposure is going to be materially much more than it is today, which will actually be a good thing because of the performance, but then that is even more concentrated in the future. So you should think about your future position as well and what bet, because otherwise you have to unwind that bet. And then there's going to be taxes associated with that if you want to then invest in just a plain market index fund. So it's very tricky. It's very tricky. So I tend not to like overthink it and just don't worry about it because I don't know. I just figure like if they do really well, then they'll grow bigger as a proportion of the market. And then so you're getting more and more exposure to them. And if they don't do well, then you haven't taken the bet. And I just assume everyone's smarter than me. So I'll just, if the market thinks that they're worth what they're worth now, then I suppose that's good enough for me. I don't know. I don't have a view. It's just hard. I think the tricky part here is sounds like the listener wants to bet on tech, like you said, but they're also nervous about that heavy tech exposure. So it is difficult. You can't really expect to have the ultra high growth of tech like we've had without then also having the downside risk that comes along with that. That just seems to be, those things kind of go hand in hand. And you can't really stop your portfolio from falling by 20 or 40%. It definitely will at some point, especially if it's invested in like broad markets and especially if it's in high growth stuff, then it's definitely going to happen at some point. As I said, you can diversify a bit more with lower risk stuff if you'd like to reduce that exposure proportionally, but you're going to have to either become a bit more comfortable with the volatility or tweak your investment strategy. So that's going to be a personal choice. But if you add other assets and they're not performing as well, will you be able to hold on to those, or will you get frustrated with those if they're not performing as strongly as maybe your US index fund is? I'm not sure, because every asset class and every market is going to suck at some point. Everything's going to underperform at some point. And that's part of the challenge with holding a diversified portfolio is there's always something in the portfolio that's not doing that well. So then you look at it in your portfolio and be like, damn, this thing, I should own more of fund A instead of fund B, right? But then the fund mix that you have is going to protect you from, a large, long-term, like permanent underperformance because you're not so reliant on one particular outcome. That's the point of diversification in the first place. So it is a tricky thing to kind of swallow.
Absolutely. Well, that pretty much brings us to the end of this episode. We covered two interesting topics. The first one was around ethical investing, DZZF. Why do people not invest in it as much as people might think? What is ethical investing? Should I be ethically investing? A lot of nervous questions from our listener that we hopefully unpacked. And we basically just talked about that ethical investing is interesting and most people are interested in it. The real question gets into the nuts and bolts of what is it actually in practice and is it what you want it to be, which is something that we could always spend more time on and is super fun. And I hope I get to as well in the future. And I think Dave's already spent a bit of time on it and had some really interesting insights that are worth going back and listening to if you fell asleep earlier on in this episode. And then the other thing we talked about was basically just around how do we diversify out of big tech. This one we had a pretty short, straightforward answer to, which was take your long-term bets, build a portfolio around it. If your long-term bets are less tech heavy than your portfolio feels like, change your portfolio. If your portfolio looks like your long-term bets, then don't worry about the volatility in the meantime, unless, of course, you can't put capital at risk. Say you're, looking to buy, or you might need the money really urgently in the short term. There's a broader question there about should I even be investing, but that's probably the only case in which, you might be interested in big tech over the long term, but you think maybe I should de-risk myself because it seems to be more volatile at the moment. But very interesting questions. The great thing about this podcast, especially if you're one of our kind of, new listeners in the last couple of months, is that a lot of our episodes are us talking about questions from our listeners, and you're able to post a question or describe your situation and have a question about it by following a link in the show notes, which will take you to the relevant form you can fill out, and we'll be able to get that. If you'd like to alternatively just email us to share a comment, thoughts, questions, otherwise, you can reach out to us at hello@aussiefipod.com, or you can reach out to Dave at Strong Money Australia on social media, or myself at Perla on social media. Otherwise, it's been a pleasure getting a chance to talk to you all today, and enjoy the rest of your day, evening, week, etc. And we'll talk to you soon.
Thanks for listening, guys. Catch you in the next one.
We hope you enjoyed this episode of Aussie Fire. For more FI inspiration, head to perla.com to browse our resources, calculators, and community insights. Perla is an authorized representative, number 1281540 of Sandland Private Wealth Pty Ltd with AFSL number 337927. Knowledge is power, especially when investing. So always seek advice and/or check out the relevant disclosure document for any financial product, including the PDS and TMD before deciding. These are available from the product issuer's website. When you invest, your capital is at risk and past performance is not a reliable indicator of future investment returns.